Hello ladies and gentlemen, welcome to the FT headquarters for our latest video production concentrating on fixed income investment. And I would like to introduce David Roberts, Head of Global Fixed Income at Liontrust. Firstly, we will look at markets and pricing. Do you feel that in the current climate, bonds are quite expensive? They can be dangerous to hold, and perhaps we should move on to more opportunistic trading?
I'd say bonds for me are certainly expensive. On many measures, they've never been as expensive. But what people, I think, forget is they are also as risky, if indeed not more risky, than they ever have been. When I mean risky, I'm talking about the amount of interest rate risk, the duration sensitivity, if you like. And one of the things we've noticed with quantitative easing is that companies and governments have borrowed money for much longer than they have done historically. And that means that if there is a reversal in bond markets, then investors stand to lose potentially quite a lot of capital. So yes, we think that avoiding some of the direction in those risky, expensive bonds makes sense. And perhaps exploiting some of the opportunities that central bank manipulation has created is a sensible way to generate returns for investors.
But does this mean that the role of bonds in a high net worth investor's portfolio has moved away from a core anchor investment to a more satellite alpha generating role?
And I would say the first thing really is to try to understand the investor needs. Now, we know that in times of extremes, then bonds can still offer some degree of protection and potential portfolio diversification. But having said that, when we look at the ability of bonds to generate either income or material capital gains from here, then really it's difficult to see that done on a sustained basis over the next few years. So the way that we're looking at bond markets is more as a trading opportunity rather than necessarily as a buy and hold long-term investment. And certainly I think for most private wealth clients that's certainly something they should be considering.
So if I can put you under the spotlight, where do you currently find value in fixed income markets?
Yeah, well, there are two ways that we look at it. The part of the major market that we think is relatively cheap is the high yield market. It's not extremely cheap, but certainly if we are in a world of low interest rates for the next few years, then the natural income, the yield generated from high yield is still attractive. But other than that, for us, it's really about relative value and trying to exploit some of the anomalies that have been created by central bank activity. So, for example, we think American bonds, US Treasuries, look incredibly cheap relative to their European, UK, or indeed most Asian cousins.
And for the first time recently, David, a lot of investors are using exchange-traded funds to access these bond markets. Are they perhaps missing out on better opportunities from active funds?
Yeah, so the first problem with buying an exchange-traded fund is that obviously they tend to replicate an index or an exchange. And, my view is certainly that those indices and exchanges are much more risky today than they have been historically, so investors need to bear that in mind. But yes, certainly some of the subtleties, the minutiae of the market, we would describe it as the alpha opportunities, which at the moment are probably greater than they have been in my 30-year career. It's very difficult for more passive index-like portfolios to capture those in the way that a successful active manager can.
So you're saying that while people are speaking with caution about bond markets, you're saying this is the time with the greatest opportunities?
It is in many respects. I think we need to be careful. When we talk about opportunity, people often think it's just a case of blindly buying the market, and for us that's where the dangers lie. But the opportunities really are from doing a little bit of hard work and trying to subtly express views in the market. So at the same time we can capture some positive returns but not take too much of that directional, dangerous bond risk for our clients.
So opportunity, but with a strong hint of caution.
Exactly. Within our portfolios, again, it's not about chasing the market direction. It's about being cautious and being careful. And as I say, trying to pick those slightly cheaper markets. I mentioned America, I mentioned high yield. So it's not necessarily having to delve down right to the very bottom of the market, but there are good opportunities even in some of the more traditional parts still to add value for clients.